Now let me layer on something else, because this is where it gets really serious. The United States is carrying a level of national debt that is frankly historic. We're talking about trillions upon trillions of dollars in debt, and the interest payments on that debt have become a significant portion of the federal budget. When interest rates were near zero, that was manageable. The government could borrow cheaply. But now, with rates meaningfully higher, the cost of servicing that debt is much more painful. Why does this matter to you? Because it limits the fiscal response too. In 2020, the government was able to send stimulus checks, fund PPP loans, expand unemployment benefits, and essentially flood the economy with money. That's what I mean by a fiscal response: government spending and support. But when you're already carrying enormous debt and your interest payments are eating up a huge chunk of your budget, the political and economic appetite for another massive stimulus package shrinks. The room to maneuver gets smaller. So not only is the Fed more constrained than before, but the government's ability to back them up with big fiscal firepower is also more limited. It's like trying to fight a fire and realizing the water pressure is lower than it used to be, and you're not quite sure when it's going to run out entirely. Here's where this hits your portfolio directly. For about 15 years, from roughly 2008 to 2022, we lived in a low-interest rate environment. And in that world, a very specific set of assets thrived. Growth stocks. Companies that weren't necessarily profitable yet but were growing fast, got valued at astronomical multiples because cheap money made future earnings worth more in present-day terms. Real estate boomed because mortgages were cheap and borrowing was easy. Bonds performed well when rates fell. And every time there was a wobble, the Fed cut rates and everything reset higher. That was the environment. And a whole generation of investors has built their entire mental model of markets around it. If you started seriously investing after 2009, you've basically only known that world, but that world has shifted. We're not in a zero-rate environment anymore. And the transition back to that world, if it ever fully happens, is not going to be smooth or quick. In the meantime, the assets that were priced for a low rate, Fed always saves the day world, may face a much harder road. This doesn't mean markets collapse. It doesn't mean you should panic and sell everything, but it does mean the passive, set it and forget it approach that worked beautifully in the last decade needs to be paired with a deeper understanding of what you actually own and why. So what do you actually do? Let's get practical, because that's why you're here. The first thing is to stop outsourcing your financial thinking to the assumption that someone else will fix it. Whether that's the Fed, the government, or your employer, you need to be the one driving. That starts with understanding your own balance sheet. What are your assets? What are your liabilities? Where are you exposed to interest rate sensitivity, whether that's through adjustable rate debt, through long-duration bonds in your portfolio, or through highly valued growth stocks? Second, think seriously about diversification. Real diversification, not just owning a bunch of different tech stocks. In an environment where the traditional Fed playbook is constrained, some of the assets that tend to hold value are ones that don't depend on cheap money or loose policy. Hard assets like commodities, energy, or real estate. Not just REITs, but actual physical real estate if you are in a position to invest in it, tend to have different dynamics than the paper assets that flourished in zero-rate world. International diversification also becomes more relevant when domestic monetary policy is constrained. Third, and this is the one people resist the most, get your cash flow under control. In a world where the safety net has holes in it, your personal runway, how long you can survive a prolonged period of economic disruption without being forced to sell assets at the wrong time, becomes one of your most valuable financial assets. An emergency fund isn't boring. In a constrained Fed environment, Liquidity is actually a strategic position. Let me ask you something. What do you do when the safety net you've been counting on your entire financial life suddenly has a hole in it? Because right now, millions of people are about to find out the hard way. The Federal Reserve, the institution that has bailed out markets, saved banks, slashed rates, printed money, and basically acted as the economy's personal bodyguard for decades, may not be able to save you this time. And I don't say that to scare you. I say that because understanding why is the most important thing you can do for your finances right now. So stay with me, because what I'm about to break down changes how you think about investing, saving, and protecting your wealth going forward. First, let's talk about why we even expect the Fed to save us in the first place. And honestly, they've earned that trust. Think back to 2008, the financial crisis. Banks were collapsing. The housing market was in freefall. Unemployment was spiking. What happened? The Fed stepped in, slashed interest rates to near zero, and pumped liquidity into the system. Markets eventually recovered. Then 2020 hits. A global pandemic shuts down the entire world economy. Businesses close overnight. Unemployment spikes to levels we hadn't seen since the Great Depression. And again, the Fed swoops in. Rates go to zero. They launch massive asset purchase programs. Stimulus flows. And what happens? The stock market, after a brief crash, goes on one of the most remarkable bull runs in history. So you can understand why people think of the Fed as a backstop, as the institution that will always show up, the fixer, the last resort. That belief is baked into the way most retail investors think about risk. A lot of people subconsciously make investment decisions with the assumption that if things get really bad, the Fed will just cut rates and everything will be fine. But here's the thing. That playbook has a very specific set of conditions under which it works, and right now, almost none of those conditions exist. Let me explain. The Fed has two primary tools. It raises interest rates to cool an overheating economy, and it cuts rates to stimulate a slowing one. Simple enough, right? But what happens when the economy is slowing and inflation is still elevated at the same time? That's the trap. And that's pretty much where we are right now. After years of aggressive rate hikes to fight the inflation surge that came out of the pandemic era, the Fed managed to bring inflation down, but not all the way to its 2% target. And here's what's new in the picture. We've got tariffs. Broad, sweeping tariffs on imports from major trading partners. And tariffs are not a neutral economic force. They raise the cost of goods. They're inflationary by nature. So even as the Fed is trying to navigate a slowing economy, there's this new upward pressure on prices coming from trade policy that is completely outside of the Fed's control. Think about what that means practically. Normally, when the economy starts to wobble, the Fed cuts rates. Lower rates make borrowing cheaper for businesses and consumers. It stimulates spending and investment, and the economy gets a boost. But if the Fed cuts rates right now, with inflation still not fully tamed and tariffs pushing prices higher, what happens? Inflation comes roaring back, and then they're in an even worse position. So the Fed is essentially stuck. They can't cut aggressively without risking an inflation surge, and they can't keep rates high forever without potentially pushing the economy into a harder landing. That's the bind. And that bind means the Fed's most powerful tool, the rate cut, is not fully available to them the way it was in 2008 or 2020. Here's the honest, big-picture truth. The Federal Reserve is still powerful. I'm not saying it's useless or that it won't try to respond to a downturn. Of course it will. But there is a real difference between a Fed that can cut rates from 5% to zero and inject trillions into the system freely, and a Fed that's navigating sticky inflation, political pressure around tariffs, and a debt-laden fiscal backdrop. The margin for error is smaller. The tools are more constrained, and the outcomes are less predictable. And what that means for you, the individual investor, is that the era of complacency, where you could just trust that monetary policy would backstop your portfolio every time, needs to give way to an era of actual financial literacy and preparation. Not fear, not panic. Just a clear-eyed understanding of the environment you're investing in. The people who come out of complex economic environments strongest are never the ones who hoped someone else would save them. They're the ones who understood the risks early, made thoughtful decisions, and didn't need a bailout to be okay. So that's the picture. The Fed is not omnipotent. The playbook that worked for 15 years has real limitations in the current environment. And the best thing you can do is educate yourself, audit your own financial position, and make moves that don't depend on someone else riding to the rescue. If you found this useful, do me a favor and hit that like button. It genuinely helps this channel reach more people who need to hear this kind of analysis. Subscribe if you haven't already, because we go deep on this stuff regularly. And drop a comment below. I want to know what you think. Do you believe the Fed can still pull a rabbit out of the hat? Or do you think we're in a fundamentally different era? Let's talk about it. I'll see you in the next one.